It's the revenue meta. If you are making money and maybe even buying back your token, Hype, for instance, is trading at $38 right now. Do you know what it was trading before this entire thing happened? It was trading at 42. Any other altcoin, it's done. It's toasted. It's down 40%, 30%, as basically every single one of them is. The reason why Hype is not is because it's buying back $4 to $5 million of its token every single day.
This episode is sponsored by Canton, the only public permissionless blockchain built for institutional finance. We'll hear more from Canton later in the episode. But for now, let's get started. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. Hello everyone. Welcome back to another Bell Curve Roundup. You got Michael's 1 and 2. Vance, fellas, how we doing?
Sunday, bloody Thursday, man.
There's support at 0. Or maybe we can go into negative numbers.
What's going on?
I shared this chart with Michael yesterday, but yesterday the quantum stocks went down like 45%, and today they went down another 11%. So today they're actually up relative to the rest of the market, but I mean, holy shit, equities are getting absolutely destroyed. Honestly, crypto's hanging in there relative to the equities, but I think there's this whole cohort of like Robinhood people who are just balls long the data center complex and are now just executed.
Well, I was going to say there's a superposition joke somewhere in there about the quantum stocks being up or down. I had to get that joke.
They'll both be up or down if you don't check them.
My portfolio is in superposition right now. I have no idea. It could be anything. I have no idea.
What is your portfolio? Nobody knows.
Schrodinger's bag. You don't want to look at it because it might disappear.
Look, I think I actually do think like that is probably an under-discussed element right now, which is the intersection of Robinhood bringing in basically like highest growth, memeiest stocks with crypto means that when you give that access point, what happens after 1010 is that people are just like, all right, got to find liquidity everywhere and got to be able to shore up holes. I got to fix this. I got to do that. I got to pay this bill. And maybe I'm going to harvest some tax losses before the end of the year because I bought it 75 and it's trading at 40. Like the stuff that I think has been going on is definitely real. And I Chow from Alliance had a good tweet, which I think he was the one who tweeted this, where he was like, if you, my brain is like all of these positive signals, QE, you've got Fed cuts, you've got, like lower inflation, like all the things that you would hope to be in line for what is happening right now. And these are all economic in nature. But then you've got my gut, which is all the kind of psychological elements and kind of the sentiment right now, which is everybody's just like, end of the 4-year cycle. That was the top. It's over. And like, pack it up, go home. Well, might as well sell before everybody else does. And I think what I ultimately think will happen is unless there is something that bubbles up to the surface in, the data center trade, the quantum trade, whatever that may be, unless there's something that bubbles up that's really dangerous or disastrous, people will come back into it. And what will happen with crypto is that this will also realize that is not a crypto specific problem. Because if you remember, everything that happened in 2021 or following 2022 and 2017 was a crypto-specific phenomenon, which ended the 4-year cycle. This is not a crypto-specific phenomenon right now. And so I don't think, if we were to track this as a 4-year, it just isn't. It isn't going to end with the 70% drawdown in every asset in crypto because there isn't, the FTX blow up or, the ICO craze being over or just the outright fraud that happened across the entire industry. And so until that happens, I think that this is going to be a sell-off. It's not the end. And people will probably jump back in. Is that, November or December or January? We'll find out.
Also, there are things that are not like syrup is bottomed. Like it went up today actually, which is pretty odd. Same thing with Sky. Like the DeFi names are kind of hanging in there, like the alt season that never happened is kind of meant that these things are like perma bottomed in the sense that there's no other sellers. There's no other buyers, which is unfortunate, but there are no more sellers, and that is the process of a bottoming. So, I mean, look, like the Pico bottom for Aave was $50 in June of 2023. It's at 192 right now. The tariff lows were 124. Like these things are kind of hanging in there.
Mm.
This may be the alt season that people get, maybe not the one they deserve, but there's things that have bottomed. It seems like at least.
And so what's the through line of that? And this is something that Vance and I were actually talking about, which is it's the revenue meta. If you are making money and maybe even buying back your token, Hype, for instance, is trading at $38 right now. Do you know what it was trading before this entire thing happened? It was trading at 42.
Mhm.
Any other altcoin, it's done. It's toasted. It's down 40%, 30%, as basically every single one of them is. The reason why Hype is not is because it's buying back $4 to $5 million of its token every single day.
I saw the Chow tweet as well, and actually, my commentary on that as well was it. Obviously, there's just market forces here, which every coin can't fully escape. But I think I basically had the exact same thought: is that you're going to continue to see. This has not been an even bull market, even for the last 3 years. Like some assets have done far better than others, and I think that now, for the first time, you actually have real institutional capital coming into the space that fundamentals, it's not the only thing that matters, obviously, but it will matter more and more. But I think it might confuse some people because even there are good projects that have good fundamentals, but they are maybe technically overvalued at their current price.
Right.
So you might actually see good projects that have real revenue actually re-rate down, but then go up, right? I think that might be the phase that we're in at the moment.
Totally. And I mean, this is something that I think was commentary around Palantir, even, which is,
Yeah.
the Michael Burry $1 billion short. I think for him, it's like Palantir is probably a really good company. Is Palantir worth like 2000x price to earnings? Probably not.
No.
And so maybe it's not valued properly, but it is still growing at an exceedingly impressive rate, and it is a very successful business. And so that's kind of like where the rub is. It's like not all of these are frauds, and not all of these are going to be like the things that sustain. Maybe somewhere in the middle is a lot of them. But here, what I would say, just to follow up on the final thought on the Chow perspective, which is as an investor, if you're trading with your gut and your psychology and sentiment, that probably works in the short term, but it fails you in the long term. If
Yeah.
you're trading with a very sober sensibility and with fundamentals, that will do you well in the long run over time. And you may have to take some short term pain to get there. But that's how I break down that analysis. The only thing that is potentially different is what he also kind of said. I think maybe not in the same tweet, but another one, which is if the self fulfilling prophecy self fulfills, which is maybe the sentiment short term gets so bad that something bad happens. But once again, that's like the reason why Celsius blew up is because all these assets were crashing. The reason why FTX blew up is because they tried to pull liquidity off, and we found that there was this massive fraud underneath. I don't think that that's the case. And so unless that happens again, I don't think that the self-fulfilling prophecy will self-fulfill.
Yeah. So I want to actually, maybe that'll segue into our first topic, which was some of the stress that we saw in on-chain lending markets. But before we get there, actually, guys, just have an announcement for Bell Curve listeners here, which is a little bit of a bittersweet announcement, but actually ultimately a super positive, which is this roundup, we're actually dividing and conquering in the future on Bell Curve. So basically, Michael and Vance have outgrown yours truly as a host here, and they have a slightly new version for a show, which is maybe a little bit beyond the scope of just crypto, where I love to stay nerding out. But yeah, fellas. But for listeners, this is not a goodbye to Bell Curve. You guys are still going to be doing this on the Bell Curve feed,
Right.
and maybe we can do some, co-collabs from time to time, cross on the airwaves. But yeah, guys, can you just give like a quick, 2 cents around what this new show is going to be, when listeners can expect it, all that good stuff?
Yeah, so once again, it's still on Bell Curve. It's just a different maybe content bid, and it'll be two voices instead of three. But have loved building this over the last couple of years and collaborating on it, and it's exciting. But have enjoyed the ride so far, and I think kind of the 30 or 10-second teaser is we definitely are going to be talking about crypto markets as they come up. I think we're also going to be expanding into maybe where crypto is going, which is expanding into other technology categories, whether it be AI, energy, or some of the kind of more, I would say, earlier stage, but interesting, super differentiated perspectives of what crypto is doing. And DeFi is still the core, but it is going to be many different other things at the same time, and maybe even expanding outside of crypto itself. Maybe talking about San Francisco, where we're based, talking about different categories within technology, or life and philosophy. Who knows? It's going to be fun.
Yeah,
Awesome.
no, I think we talked about which show that we wanted to base it off of, and funny enough, it's like Uncommon Core was one of our favorites for back in the day with Hasu and Sue, which obviously didn't end great for one of them, but this show will be more philosophical, more broad, but basically all crypto. It's not changing from that. Just want to make that clear.
Oh yeah, fellas. Well, there's still going to be tons of like I said, still on the bell curve feed, and maybe from time to time we can still do fun collabs and everything like
Yeah,
that. But
100%.
okay, guys. So everyone, just stay tuned for that. That'll I think start up after Thanksgiving is the current plan. But yeah, perfect. Before we get back into the episode, here's a quick word from our sponsor, Canton, the only public permissionless blockchain built for institutional finance.
TradFi wasn't built for 24/7 markets. DeFi wasn't built for regulated institutions. But Canton is where the power of finance meets the promise of blockchain. The only public blockchain with institutional-grade privacy, true composability, real assets, real markets. Why reinvent finance when Canton makes it work the way it should? Canton, where finance flows.
As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Let's talk about lending markets here. Can we just talk about 1010? So I actually had Sonia and Romeo on the show last week. They were talking about this from a pretty in the weeds perspective. But yeah, the listeners got a little bit of a preview of this where we talked about some of the liquidity that dried up. But I thought it would be interesting because kind of if we are going into some kind of downturn, this is typically when those kind of credit crunches happen and you see who's swimming naked. And this is going to be kind of a first big test for DeFi, I would say, which is in a much more mature place than it's ever been. And I would like to get your guys' take on what happened, but also, if you see more stress coming to these markets. And then, Vance, I saw you tweeting about RWA-looping in general. So maybe we can kind of start with just the State of the Union and then maybe end on the RWA-looping idea.
Yeah, I mean, what's clear from the stablecoin blowup is that there's people interested at borrowing at SOFR plus 100 to 200 and lending at rates that they think could be as high as 11 or 12, and it makes sense, right? In the last crypto bull run, there were no positive interest rates for the most part, so like that didn't really make as much sense. And so I think what we're seeing is the start of RWA looping. I'm coining that term. If you hear anybody else say it, I said it first. Fuck those people. But basically, what that means is you're going to see private credit come on chain. You're going to see new forms of credit come on chain. Like Daylight and USDAI are just starting to fill loan tape. And I think those are going to be huge going forward. I think Sky will have a big role to play here. I think Aave's Horizon market will have a really huge role to play here. And I think kind of the things that probably are less relevant are these kind of like, I don't know, like crypto native, like meme coin markets, those types of things. Like maybe those are going the same way as the NFTs, and they're being replaced by this looping phenomenon. Which, if you think about the crypto native ways to trade, perpetual futures and looping are the two that are kind of native to this industry. And so it's really cool to see that community form. It's really terrible to see there's a blow up involved, and we still don't know where the stream finance money went. So like, if we ever figure that out, maybe we should have a pod on that. But it's awesome that it's forming. It's a net new type of community which we have not seen in a long time. So I think that's something to celebrate.
Yep. Only things I'd add are, going back to 1010, it seemed like that originated from a specific vulnerability within Binance in the pricing for USDE. There's been billions of outflows from USDE since, and that's kind of like circled around different other yield opportunities within crypto. I would not categorize this as like the first kind of test bed for DeFi. We've had many test beds, some of them more violent than others. But I'd say there's a huge difference between looping or looping or reusing versus rehypothecating. And where assets have gotten or ecosystems have gotten in trouble historically is rehypothecation to counterparties that frankly lose the assets. And that's where you get in these like upside down insolvency issues that we saw in 2022. The beautiful part of DeFi is that it's extremely difficult, if not impossible, to have that be the case. Because these assets live on chain and that's kind of the direction that everybody is moving. You may have these like violent price action issues or these things where you have cascading liquidations. And look, looping in RWA, if there's a change in the value of that RWA, you can have cascading liquidations pretty easily if you amp up leverage crazy. But a rehypothecation is totally different and creates a totally different risk vector that I think is not possible within DeFi and the way that it's being built. So I would say that's really like the delineation that we think about. And so when you think about unloading events or de-risking events like 1010, it's painful, but it's not existential.
And I think there's also a bunch of interesting questions that come from this community, such as who can liquidate RWAs? Like who's allowed to? If you don't have a brokerage account, you can't really like take custody of that and unwind it, right? Same thing with lending markets. Same thing like trading these fixed income securities. And so we're super excited to hopefully back a few things in this space that really push it forward. But it'll be more institutional looking. It'll be more KYC, more whitelisting. And so there will be kind of a departure from the cypherpunk ethos, but I think that's okay.
Yeah. And maybe just double clicking into that a bit. One thing that we describe is in to partners or LPs in the space is in 2021, you had basically 10% institutional capital and 90% retail capital.
Yep.
And that kind of breakdown of the landscape meant that you had token protocols who were launching airdrops that were really centric towards or centrally focused on communities. You had really people who cared about kind of the governance process and people who were getting paid to be governance participants. And it was very community centric and it was very retail oriented. And I think after a couple of times blowing up retail, frankly, that has started to shift. It also has really dramatically shifted in the last 18 months with the advent of the ETFs and the institutional products. And so now I describe kind of the landscape of investment dollars or just kind of dollars on chain as being 90% institutional and 10% retail. And what happened after 1010 is probably that 10% retail went to like 2% because everybody lost, all the perps value, all the cascading liquidations. It's just like retail has just been like lambasted and flogged so many times that they're just not coming back. They're not getting up off the floor. And so I think it has been kind of a slow moving process in some ways, but in other ways it's been very quick. And that institutional capital is what is going to drive DeFi and these markets going forward, which means that it really is going to be an institutionalized product. If you want access to it as an individual participant, you'll be able to access it at the same level as institutions. But people who care more about 2 or 3 or 4% net interest margin are really the customers that these protocols are going after, not the ones who wanted the free airdrop who are going to dump it within 24 hours, or the ones that were looking for the 1,000% APR pool twos in 2021. Like that stuff is gone. And so I think I'm very excited about where things are going just because it is much more durable value. It's much more sustainable value. And the counterparties are going to be there for the long run because they're the most notable financial institutions in the world.
Yeah. I want to talk a little bit more about the RWA looping. We were actually, we had Sonia and Romeo from 3F, so disclosure, small but proud bag holder of Vance. They might object to your coining of RWA looping, but I am curious. I am curious on the institutional side. One thing that's kind of put my brain in a knot, and I'd be curious to get your perspective on this, is I completely agree with the idea that most of the capital in the space is institutional. At this point, I was listening to a friend of mine is basically starting a kind of a what's it called, like a risk curator type business, and branding is institutional. And in my head, I was thinking, okay, but what's the advantage here over something like Steakhouse, right? Which I don't know if you'd say they're institutional or retail, but I feel like the trend is you kind of start with retail, build up a base, and then you pivot institutional or you onboard the institutional customers. So this is maybe more of a positioning question from the perspective of founders, but what advantage do you get of only being institutional versus just serving both? Is it a focus thing?
So there's multiple elements to it, which is, well, first off, one participant is 1,000 to 10,000 times bigger than another type of participant.
Yeah.
Institution is going to be at minimum deploying tens of millions of dollars versus tens of thousands of dollars for a retail participant. So like the size is really what matters. Number two is, in a world where we are hopefully moving towards clarity, like literally Clarity Act, that will hopefully give us some understanding of what these assets are and how to regulate them. But if you got counterparties that can KYC and prove that they are accredited or qualified, that is a very different risk reward profile when you're talking about things like real world assets that actually are securities on chain. And even 2 days ago, Paul Atkins said anything that is a security in the real world or not on chain is also going to be a security on chain. And so if we're talking about Janus Henderson CLOs, AAA ETF, or if we're talking about tokenized treasuries, or if we're talking about anything private credit moving on chain, those are securities. And so like it is very difficult to have a retail audience interfacing with those because they're just like the current security regulatory regime is very clear. And Paul Atkins also said in the speech he expects to change this, add more exemptions. Once we get there, maybe retail can come back and participate at full fledged. But in the meantime, it's going to be institutions that can kind of access these things. And so that's another element to it. But I would say, the other reason why I think historically retail has been a participant in these ecosystems and just, calling it out is because they've wanted to be able to access venture scale like returns in the tokens that aggregate value. And protocols have structured themselves to be operating in that way. And they've expected that the protocols and the kind of like positioning and the branding of the protocols will attract buyers of the asset that want that type of exposure. Well, I propose to you that what if you build a sustainable business model and instead of relying or hoping on these individual people coming in and buying your asset because they think that it's attractive, what if the protocol itself is the thing that's buying these assets and is the largest holder of the protocol token and is using the cash flows that are generated by the sustaining and profitable business model to do so? In which case you have no need for an individual retail audience in your protocol whatsoever, because it's institutions borrowing, it's institutions lending, and it's the protocol itself that's buying the asset. That's a pretty strong loop that I think we're just starting to see kind of like what that would look like in some of these protocols, but it doesn't require a participant that is an individual going forward.
Super interesting. I wonder if, this is one of those lessons where, I think a lot of, going back to like 2017, 2018 timeframe, there were a lot of ideas that might have been right just too early. And I think one of the things that will mess up a lot of people that have been in crypto for a long time is you see a graveyard of companies that kind of had this approach. But what's different now, obviously, is you have Clarity and Genius and, they embrace. So, yeah, I think there are a lot of areas that are like this, right? Where you really have to question your priors to understand what's going to work in this day versus what's worked in the past. But I guess just like final word on RWA looping in general, like where do you see early traction on different types of, so you mentioned USD-AI. So that's a stable coin, which is secured by cash flows from GPUs, right?
Yep.
If I believe. Yeah, and Meltem was on stage at DAS talking about something similar. She might be a co-investor with you guys. But I'm just curious, like, where do you see on the looping side of things, like, where do you see traction from different types of RWAs, I guess?
And energy and compute, I would say, are the two kind of obvious ones. There's also like CLOs and like ACRED, which is Apollo's product. I think with all of these things, there is this duration question where most of the classical RWAs that we talk about, or that are even in like the ETFs that package them, do have some duration component to them. That does not mean that they are not immediately liquid or cannot be made to be so. But there is this question of, typically you have on-chain liquidity that you can access atomically. But if you are looping even something as simple as like USDTB, which is the BUIDL token, or I guess Athena's kind of version of the BUIDL token, BUIDL only works market hours. So if you need to get your money out, you have to wait till 9 a.m. the next morning. So you need to build some sort of like overnight repo facility, and that will be like another interesting product that gets created. And so like the tranching and liquidity and the duration of these things is really kind of the next frontier that we need to push into, as well as things that are able to liquidate these things compliantly, trade them compliantly, lend against them compliantly. So I think there's also this exciting vector of just there's tons of new products that need to be created to facilitate this. But this is going to be a multi-year trend that really the value accrues to the people who hold the RWAs. And a lot of that right now is Sky.
And just to like RWA is such a loaded term to like double click into that. I think what we're typically talking about here is like a dollar based asset that accumulates yield from some sort of business activity or some sort of like lending activity. And that I generally say is, yield coins maybe, but you're like putting in stable coins or collateral and it is accruing to the value of this asset. And I think that as the stablecoin industry grows, there's just going to be even further and further demand for this because those assets are going to come on chain and they're going to be seeking some sort of yield. Unless all the USDC is kept in Coinbase and earning whatever Coinbase is paying you as an incentive, there's no other way to get yield on your stablecoins on chain. And so I think these opportunities are scaled to hundreds of billions of dollars of collateral. I mean, look at what the AI data center capabilities are in terms of sucking up capital. Think about what that would be for energy. There's commodities trading that is moving on chain. There's also trade finance that is moving on chain, where customers that are some of the most notable, without saying names, like financial or payments facilitators in the world, they're interested in borrowing because JP Morgan's charging them 15 to 16%. Well, what if you can charge them 12%? Like that's a pretty attractive proposition for them, and it's pretty attractive, I'd say, for people on chain as well. Like that type of a dynamic is something that I think we're provisioning access to, and it's going to live on chain, and it's just going to be more transparent, and there's going to be a cost reduction element to it because of that. So, like that's kind of the outset of what this RWA ecosystem I think becomes. Tons and tons of opportunity.
Yeah, I think the repo market's a super interesting analogy here, where there's an observable pattern in TradFi, right, of basically taking a very safe trading strategy, like a convergence trade you run on treasuries, and just levering it up to take more risk on it. And so it makes sense to me. I was actually listening to the Zach guy from Bridge talk about this. He had a really great phrase. I'm going to forget exactly how he described it, but a lot of that financial activity is just going to move onto blockchain rails. It facilitates it much better. So yeah, excited to see what happens in this world. Everyone in crypto loves to talk about transparency, but would any serious business publish its payroll for the world to see or hand competitors its contracts? That's not a feature. That's a bug. And it's why most financial institutions can't operate on today's public rails. Canton Network is different. It's the only public permissionless layer 1 blockchain built with privacy at its core, sharing data only on a need-to-know basis. That's why Goldman Sachs, NASDAQ, and Broadridge are already building on the network. Only Canton delivers the network effects of a public chain with the privacy and control real finance demands. Learn more about Canton by following the link in today's show notes. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Speaking of alts, regulations, changes, we got a proposal this week from Hayden from Uniswap, the long-awaited Uni fee switch. So this is, I'm not actually going to read from the post. I'm just going to read the summary that he posted on Twitter here. So today I'm incredibly excited to make my first proposal to Uniswap governance on behalf of Uniswap. Okay, this proposal turns on protocol fees and aligns incentives across the Uniswap ecosystem. Uniswap has been my passion and singular focus for the past 8 years. Yada yada. I'm going to skip actually to. So he mentions this restriction of not being able to turn the fee switch on was in great part due to a hostile regulatory environment that cost thousands of hours and tens of millions in legal fees. Fortunately, the regulatory environment has shifted. This proposal comes from a strong desire to see the Uniswap protocol win as the global decentralized exchange for tokenized value. At a high level, the proposal 1 turns on protocol fees and uses them to burn Uni. 2 sends Unichain sequencer fees to the Uni burns 100 million Uni from the treasury, representing the protocol fees that could have been burned if fees were turned on at protocol launch. Introduces protocol fee discount auctions, a new way to improve LP outcomes and internalize MEV to the protocol. It introduces aggregator hooks, which turns Uniswap v4 into an on-chain aggregator that collects protocol fees from external liquidity sources. And this is a big part of it, which is Labs will stop collecting fees on its interface, wallet, and API to supercharge distribution and adoption of the Uniswap protocol. So that's, big update there. So I think those are the main parts of this. And obviously it hasn't passed yet, but I think that people are generally first of all, people are generally pretty bullish on this because this is coming from Hayden for the first time. And so I would love to get your guys' breakdown on not only the specific terms of the proposal, but also what this means for alts. Because I think this is kind of a bellwether, very symbolic act that's been talked about for a long time. So wherever you want to start on the specifics of the proposal or what it means for alts in general.
This has been talked about for years. I think, what are the chances it doesn't pass? I'm kidding. But actually, this truly has been talked about for years. I think it's great to see kind of a recognition of what's going on, and maybe the directions of where kind of the industry is going in terms of value accrual. And yeah, I hope that it is well received and it actually works in the way that people hope that it will. I do think that there is a real big question, and you kind of touched on this, Mike, but if you are a shareholder of Uniswap Labs and you do not own any Uni tokens, how do you feel right now? Pretty terrible, in that you invested, they raised $100 million at a $1 billion valuation for something that was making $10 to $100 million of ARR that just got turned to zero. I don't know how they ameliorate that, or how, maybe there's some kind of backroom negotiation that happened for that to happen. But this touches on something that we've talked about multiple times on this show, which is who gets favored. Is it the shareholders or is it the token holders? Well, I guarantee you that the shareholders definitely have rights when it comes to securities laws. And they definitely have shareholder protections when it comes to securities laws. And unless you are declaring that the Uni token is a security, those rights do not persist for the token holders. And so there's going to be a big kind of question, I would say, that comes from this as to how do you traverse both having an equity and a token? If you're talking about the same value accrual mechanism for both, you're obviously going to be disadvantaging one of them when you allow for one of them to have that value accrual. So maybe this gets sorted out in the fullness of time. Maybe things already have been sorted out behind closed doors. Who knows? But that was my visceral reaction, just because I thought that this would be a perfect case study as to how this could potentially get sorted out. And it looks like the answer is we're going to basically take the balloon and squeeze one end to benefit the other end.
Yeah, I agree. I actually hadn't even really thought about it from the perspective of the shareholders, but that's really tough. I mean, I think Uniswap is in a really difficult position. They are, in a sense, maybe not to sound overly negative, but a little bit of a casualty of the Gensler era here, where I fully believe that they're a great, team that had all the right intentions, but you were just limited in terms of what you could do during that period of time. And I think Uniswap was kind of sometimes talked about as kind of the poster child of this weird clash of incentives in between an equity instrument and a token. And I have to respect Hayden here. I think he is plowing through and doing maybe the short-term painful but long-term thing that needs to happen, which is having both of those. To me, it just feels, I have a strong internal bias towards things that are clean. And so it was just always going to be tough to make both of those things work. But it's interesting because at the same time that we see Hayden doing this, we're also seeing Circle talk about their new L1 ARC having a token. Almost every major exchange has a token. It's like folks are going the other way too. And so, yeah, I guess that's kind of also an interesting meta point. But for me, also why this is symbolically important is because with the backers that Uniswap has, Uniswap could have done this at any point. They're doing it now. I think people will view this as a line in the sand that others can safely accrue value to the token. And you saw Lido. There were some immediate follow-on proposals that also, directed fees to token holders, Lido being a major one. So I don't know. But I have no idea what's going to happen to the shareholder side of things. Like, I think they'd have to get made whole somehow, right?
Something tells me probably not. I would also say, I saw some math being done on Twitter about how much the buybacks will actually be, and saw some some other math from the Aerodrome team on what they might actually be. And I think there's not a broad consensus on how much volume is going to be able to be monetized here. I think it could be as low as high eight figures of millions of dollars per year. It could be as high as like 400 or 500. But a lot of the analysis that I saw that was interesting was if any fees are charged on any of these pools, they become uneconomic, especially ones that are doing wash trading or kind of low volume coins. And so there is kind of like these interesting second order effects that will start to become apparent once this is actually flipped in terms of what is the viability of a go forward business model based on a fee switch. I imagine they have also done this math. So it's, smart people disagreeing on something that should be quantifiable, which always makes for an interesting discussion.
One thing as well that I feel bad, maybe to be a little bit more negative Nancy, but there's okay, what does this mean for the whole space? But then what does this mean for Uniswap specifically? And, it kind of struck me as I was reading this proposal. It's like, man, there was a point when Uniswap was just so dominant and this would have been such a market moving event. But now you kind of look up and you're like, it seems like Uniswap has lost market share. It doesn't seem like that. They've lost market share.
It doesn't seem like that. They have.
Measurably.
Especially on base and on kind of the new most important chains, they've definitely lost market share. And I think the other thing is that Aerodrome seems to be gaining market share. We don't hold Aerodrome, but I was tracking their announcement of they're combining tokens. They're moving to Ethereum mainnet. They're also launching on Arc. It's going to be more of a horse race from here on out, basically for the entirety of crypto. And I just think this like legacy first mover advantage is just basically gone.
And I agree. I think they are a casualty of the Gensler era. And maybe this is a little bit too punitive, but I also got the sense, like, one of my visceral reactions was them finally turning this on after years of deliberating and debating. And also it's like, we've known what this is going to be for quarters now, maybe even months. Like, why this week is the week that you choose to do this announcement, not even like earlier this summer. And it just feels like OpenSea finally announcing their open token or their C token, whatever it's going to be. It's like, this is like years too late. And so I think maybe it's reactive in that sense where they notice, that things are kind of dwindling and trending poorly. But yeah, it does feel a little bit reactive, and it feels like it should have happened way sooner.
Mm-hmm. Yeah, and to be like a little bit more positive as well is like they've still got the brand, they've still got dominant volume on ETH main chain. Like, one way you could look at it is if you're a believer that DEX volume is going to take back off on ETH main chain, like they've still got all the volume there. But yeah, I think that they've got their work cut out for them, it seems like, from this point on. One other small meta point here too. I don't know what you guys think about burning 100 million uni tokens. That's from the treasury. I don't see what that gets you at all. I think I've never seen those burns correlate to any number go up action at all.
No.
So this was a big debate with Sky as well, where there was all these tokens that had been bought back they were literally just being kept in this multi-sig. No corporate entity around it, no foundation around it, no voting process around it. And people were like, what we should do? We should send those to the burn address. What does that accomplish? It doesn't accomplish anything. Like, the right structure for these things is those tokens go to some sort of permanent capital vehicle. That's something I disagree with on the Uni fee switch one, where it's like, we're going to fund ourselves with Uni tokens each year, where the mandate is to never sell the tokens, but to develop technology that is open source that benefits everyone in that ecosystem. Like, there are no good things to do with these like tokens that have either been bought back, including burn them. Like, they should be held in a permanent capital vehicle that's used to push the ecosystem forward with tight controls around the major ecosystem stakeholders and their governance process as to what to do with them.
Yeah. I mean, so when you say the permanent, is that DATs for the most part that you're thinking of?
No, not DATs. No.
Okay,
sorry. I think of those as non-permanent capital vehicles.
Oh, interesting.
You may be about to use the FAFO method to figure out
whether they really are or not.
Those tokens are. But
talk about a narrative and a category that is dead beyond dead.
Dead. That was so crazy because it was so obvious the whole time as it was going through. And
really? Was it obvious?
A lot of
people that were contorting themselves into some MNAV calculations.
Oh my God. Well, although maybe to be fair, it does look like Bitmine and Strategy are those guys are going to be still. That's like the two that have emerged, right? From the, I mean,
Correct.
Sailor wrote the playbook, right? But it does feel like Bitmine is going to be a permanent fixture and player in Ethereum, and unless you guys feel differently, but
The general perspective that I'd say we have on DATs, just now it looks like, I don't know if the dust is settled, but it's definitely getting closer to that settling. Is that there's two that matter. You're right. It's Michael Saylor with Strategy and Tom Lee with Bitmine. And if you're not those two, then you don't matter, and you're probably going to trade below 1x MNAV. The other thing is, it's not very easy. It's not like a sure thing that you can just get the MNAV back up. If you're trading at a 0.9, 0.8, 0.85 MNAV, you're not very easily going to be able to do a financial or corporate financial transaction that allows you to get back to 1x. And people say, oh, well, what if we just buy you? Well, buying a publicly traded company requires shareholder approval and the board, and it requires some sort of premium to market value. And so it has to be a large enough premium for it to make sense to buy the whole thing. If it's at that like 0.8x, it's only a 25% premium to get to the 1x MNAV. So like there's issues there. And the volume is the lifeblood of these things. But that being said, and volume is dwindling, if not zeroed. That being said, I'd say the crossing of the chasm moment is creating financial products that are able to be traded in brokerage accounts that have access point that is not easily accessed for basically people who can only trade in brokerage accounts. Whether this is pod shops, whether this is individuals or 401ks or what have you, if you don't have a publicly traded equity, you won't be able to get access to it or be able to distribute that product. And so I think that is the remaining kind of like value here. But that it doesn't necessarily need to take the sense of a DAT that trades on MNAV.
yeah, I agree. Maybe like in closing here, I would love to get your guys' take on, one of the points on that you're bringing up, positioning institutional and the shift of institutional versus retail money in the space has changed. I would like any other lessons or points like that, to give to the audience, because I think there are a lot of instances where the future is not going to look like the past, and we have to unlearn some lessons. We've covered some of them, like don't just burn tokens willy nilly. That doesn't mean your price is going to go up. That doesn't actually correlate to anything really. Like the implications of a more institutional market than a retail market. Like if you had to, if you could wave a magic wand and have crypto unlearn some lessons that we've learned from the past, what would that look like from your guys' standpoint?
Man, so many things. Well, airdrops are dead.
They should be.
Yeah.
Yeah.
And the community is your business development and partnerships and sales and all that. Like that's dead as well. I think that's more of the institutional or maybe just like the lack of retail focus. Like that is very clear at this point. I think what's becoming more clear, which started with hype a year ago, is that when you have real value accrual, you will be outperforming the rest of the market. Whether that means that you're not going down as much or whether it means you're going up more, depends on the market. The fundraising strategy that you have to go through, I would say, look, there will be certain funds that are able to raise a fund more so than 10 or 15 or 20% of the size that they wanted to. Those you probably count on only a couple fingers. And so if you are a founder in the space and you're looking to raise capital in the next 12 months, reset expectations. And I know we've been saying this for a while, but less capital, lower valuation is frankly the only way that these things are going to get funded. And when you come and pitch VCs, at least, if you come and pitch us, pitching a business model that happens to have a token versus here's a token, we're going to figure out a business model later is the only way to get through. Just some random musings.
I think that's all relatively true. I think the other thing is just there may be this trend where the stable coins and then their backing collateral are like in this super cycle, and then everything else is kind of just like left behind. And I think that's a very large surface area for startups, but at the same time, it flies in the face of a lot of the startups that are out and alive today. And so that could be painful. But I think ultimately it will mean that the space gets more institutional and much, much larger. And that's like this RWA looping community stuff. That's why I'm so interested in that intersection of like the crypto natives and their crypto native trading style, but these new assets and these new form factors of bringing yield on chain and the stable coins that power them all. It's just pretty awesome in my mind.
I would also just close by saying too, I think that people in this space have a really skewed understanding of what it means to create value. And creating value is really hard. And I think the archetype of a successful founder, you guys probably have some perspective on this from the fund side as well, but I think the founders that might have done the best in crypto will probably need to, many of them will just fail, but I think everyone's going to need to evolve into a place where you're scale. There's a difference between having a vision and starting something, which is what a lot of the early founders did. They were kind of this tinkerer visionary founder type into scaling. And I agree with you. Like the stablecoin space is probably the most interesting area. Very wide, very broad surface area, but you need to be able to scale into business and have an enterprise sales function that you can work with fintechs. And yeah, I think a lot of the era of kind of, hey, my GigaBrain MEV project can raise $100 million because I know some infra stuff. It's just, that is dead, and it's never, ever, ever coming back.
Honestly, that has been dead for a year.
Yeah.
Maybe it hasn't been recognized from the market. The other thing, just sorry to interject, the thing that this just peaked in my head is the perspective that you raise a seed, you raise a Series A, whatever you want to call it, and then like the next phase is you gear up for the token launch, and that is also dying on the vine as we speak. Where the ones that are going to be successful are the ones that, and I don't know if we want to think about this in like series or like stage, but it used to be like, I've got 25, 30 people. We've got like, we probably don't even have real product market fit yet, but like we're starting to scale a little bit. Like let's launch this token and have number go up. That does not need to exist anymore. And we are calling into question that with portfolio companies that haven't launched assets yet, which frankly, like the ones that are going to be probably doing the best in the next year or two are the ones that are like launching their token after they've already hit profitability and scale, and being able to say, hey, we don't even need this 3-year cliff or this 3-year like unlock schedule, because like as soon as we launch this thing, it's working, it's live, like boom, it's out, and people now have access to this value accrual that they didn't have access to before. And that I think is going to be a huge shift as well. We call this like moving from early stage to late stage in terms of your launch strategy. It used to be that you would launch it and there would be demand because there's retail. Well, what if there is no retail? And then you're talking about institutions, and institutions are going to be the buyers of your asset. Well, institutions don't care that you like are a Series B company that's still searching for product market fit. In fact, they're going to be apprehensive towards that. And so that's why I think you see a lot of these token launches happen and then fall like a stone, because it's like, okay, well, who's buying it? Who's interested in this? And so until you have a business model that works, I frankly think there shouldn't be zero buying, zero interest.
This is, I think, Vance, you've said this a lot. The cure for too many tokens is more tokens. And I think that's actually what you're seeing, which is you launch enough tokens, they fall, and eventually this is something that you actually did not need regulation to fix. And eventually people were just going to get sick of this. And it takes a while to play out, but it's played out, and no one wants the type of things, assets that people are launching. I have a sexy roadmap, a GigaBrain Anon founder, and it goes up 1,000x. That's just not happening anymore. So
Chinese team, low float, financing. Just like the shit that people used to say, it was just so absurd, and I'm glad we're done with it. But the transition is always painful. And that's why if you don't have a 5 to 10 year time horizon, it's just like, you got to have that for basically everything too. Like all these data center AI plays, guess how long data centers take to build? Long time. The uranium mining complex, I'll see you in the 2030s.
Quantum computing?
Rigatoni computing or whatever it is.
Rigetti
computing.
Fettuccine computing.
Italian team, quantum computing, low float.
Son of Boyardee family investor.
But when everything's going up, it can mask all these problems, which is, I think, historically been somewhat of the issue with crypto. But these are the times where we actually figure these things out. And the macro environment is conducive to doing that, and especially bringing productive assets on chain, which is the silver lining in all of this.
I do also think, not to underline my own point here again, but I do think one of the things that will really confuse people is even good assets are overvalued and will need to re-rate in some instances before they can resume going up. Because I think there are some assets out there, not to name any, that are great and they're winning and they're gaining market share, but the token is going down. And my perspective on that actually could be rational. You could just, the valuation could just be way too high. And that's what DeFi, this was what largely happened with DeFi, right? With Sky and Aave. It took a long time to work through that insane valuation overhang, but now they've worked through it. So there are some projects like that.
Example on that, the only thing that matters is price to earnings.
Yep.
What's the cash flow of the asset?
All these things and more will be discussed on our to be named podcast.
Exactly. All right, fellas. Well, maybe that's a good place to wrap it. And I'm very excited about the new show. Yeah, guys, still on the Bell Curve feed. And yeah, well, I'm sure we'll do lots of cross-pollination and all that good stuff, but I'm pumped for it. And
it's been great. It's been very rough. Thanks, Mike.
It has indeed. All right, fellas. We'll see you soon.
Thank you.